Getting the most out of your investments isn't just about picking winners. A huge, and I mean huge, part of the game is making sure you're not giving too much of that hard-earned growth back in taxes. Okay, so here's our game plan. First, we're gonna hit on why this stuff even matters. Then we'll dive right into 4 really smart tactics you can use, and we'll wrap it all up by talking about how to build your very own proactive tax plan. It's so easy to get completely focused on your gains, right? But what we often forget is that we have a silent partner in our portfolio, and that's the tax man. And trust me, over time, that partner can take a much bigger bite out of your returns than you think. So it's a really important question to ask yourself, because without a smart strategy, a chunk of your profit could literally be vanishing every single year. And that doesn't just sting now, it seriously messes with the magic of long-term compounding. All right, let's jump into our first tactic, managing your portfolio with taxes in mind. This isn't just about what you own, but about how you keep track of it. So to kick this off, we have to get one crucial term down pat: cost basis. Just think of it as the official starting line for your investment. The amount of profit you'll be taxed on is simply your sale price minus this number. Now check this out, because this is where a ton of people trip up. See that $1,000 in reinvested dividends? So many people forget to add that to their original cost. And look at the difference it makes. By simply tracking it, the taxable gain drops from $2,500 down to just $1,500. That is a huge tax saving from one simple record-keeping trick. And hey, here's another smart move for your portfolio, especially if you're looking for stable income: municipal bonds, or munis for short. The really cool thing about them is that the interest they pay out is often completely free from federal tax. You might not even have to report it. So the big takeaway here is really simple. Good record keeping isn't just about being organized. It's a direct money-saving tax strategy. Every single dividend you track can lower the amount you ultimately owe. All right, on to tactic number 2. Let's talk about one of the most powerful tools out there for any investor: tax-advantaged accounts. These things are literally designed to shield your money from taxes as it grows. Accounts like your 401k, IRAs, SEP plans. I mean, these are absolute game changers. Why? Because they create a kind of tax shelter. You can buy and sell inside them all you want, and you won't get hit with a tax bill every single year. This lets your money compound way, way more efficiently. And this slide really breaks down the fundamental choice you have. Just think of it as pay the tax now or pay the tax later. With a traditional IRA or 401k, you get a tax break on the money you put in today. But with a Roth, you pay the taxes now, and then all your qualified withdrawals in retirement, totally 100% tax-free. So what's the bottom line? These accounts give you a massive long-term advantage. By keeping the taxman out of the picture year after year, you're letting that magic of compounding do its work completely uninterrupted. Okay, let's get to tactic number 3, timing your sales. In a regular taxable brokerage account, when you decide to sell can sometimes be even more important than what you sell. The calendar is your best friend here. It's such a simple rule, but the impact is huge. If you hold an investment for a year or less and then sell for a profit, that's a short-term gain, and it gets taxed at your regular, higher income tax rate. But if you hold it for more than 1 year, just 1 day more, it becomes a long-term gain, and you unlock much, much lower tax rate. And just look at how dramatic that difference can be. For someone in a top tax bracket, a short-term gain could get hit with a 37% tax. But a long-term gain? Just 15%. That's less than half. A little bit of patience literally pays off. Okay, here's another really cool timing strategy. It's called tax loss harvesting. Sounds fancy, right? But the idea is pretty simple. If you have an investment that's lowest value, you can sell it to lock in that loss. Then you can use that loss to cancel out a gain from a winner you sold, which can seriously lower your overall tax bill for the year. The most important thing to remember here is that you are in the driver's seat. A paper gain isn't actually a taxable gain until you hit that sell button. By being patient and strategic, you can directly control your tax bill. Let's move on to a tactic that, honestly, so many people just completely forget about: properly accounting for all the costs that come with buying and improving your assets. Now, you can't just write these costs off like a normal expense. But here's the trick. You can add them to your cost basis. So that brokerage fee you paid to buy a stock, add it to the purchase price. That huge kitchen remodel you did, add it to your home's original price. Both of these things pump up your cost basis, which means your taxable profit gets smaller when you eventually sell. So the real insight here? That dusty shoebox full of receipts isn't just clutter, it's a tax reduction tool. Every single commission and renovation cost you track can save you real money down the road.
Okay, let's bring this all home. Let's talk about the big picture, because this isn't about a bunch of random tricks. It's about building a smart, proactive plan for your overall financial health.
And this quote just nails it, doesn't it? Smart tax management isn't something you just think about for an hour in April. It needs to be a core, fundamental part of your investing strategy all year long. And a proactive plan even helps you find a silver lining when the market's down. Let's say your investment losses for the year are bigger than your gains. Well, the tax code lets you use up to $3,000 of that net loss to lower your regular taxable income. It's a small way to turn a down market into a little tax benefit. So, we'll leave you with this one big question to think about, to really mull over as you look at your own investments. By using these kinds of tactics, you can shift your entire focus from just earning returns to actually keeping them. And that, my friends, is how you build a financial plan that's truly designed for growth.